Your age pension rate did not go up on the 1st of July, not by a single dollar, but your payment might have gone up anyway. And if you were knocked back before, you might qualify now. The pension rate is indexed twice a year, 20th of March and 20th of September. That is it. Nothing happens to the rate in July and nothing did. But the thresholds, the lines deciding whether you get the full pension, a part pension, or nothing at all, those move on the 1st of July. And this year they all moved up. Start with what the full pension pays, because these figures hold until the 19th of September. If you're single, the maximum is $1,200.90 a fortnight. Across a year, that is roughly $31,200. $31,000 a year, near enough. And that includes the pension supplement and the energy supplement. For a couple, it is $905.20 each, every fortnight. Around $23,500 a year each, or about $47,000 for the household. Those rates have not moved since the 20th of March and will not move again until the 20th of September. So if you are on the full pension, July gave you nothing. Now the assets test, where most people get caught. From the 1st of July, a single homeowner can hold $333,000 in assessable assets and still get the full pension. For a homeowner couple, that limit is $499,000, combined, not each. That catches people out constantly because it feels natural to assume you each get an allowance. If you do not own your home, the limit's set higher. $600,000 for a single non-homeowner, $766,000 for a non-homeowner couple, combined. The reason for that gap is simple. Your family home is not counted in the assets test at all. Not $1 of it, whether it is worth $600,000 or $3 million. Go past those lower limits and the pension starts to taper. For a single, it drops $3 a fortnight for every $1,000 held above the line. For a couple, it is the same $3 per thousand across the household, just split down the middle. $1.50 a fortnight comes off each partner's payment, which brings us to where it stops. A single homeowner loses the pension once assessable assets pass $733,500. That is the cutoff. For a homeowner couple, the cutoff is $1,102,500 combined. Non-homeowners run further again, out past $1 million for a single. Then there is the income test, run completely separately. A single can have income up to $226 a fortnight before the pension starts reducing. Above that, it comes down 50 cents in the dollar. The pension stops altogether once fortnightly income reaches $2,627.80. For couples, the free area is $396 a fortnight, combined. Past that line, each partner's payment drops 25 cents for every dollar of income. The couple's pension stops completely at $4,016.80 a fortnight of combined income. Just over $100,000 a year, in other words. Centrelink runs both tests every time. Then it pays whichever one produces the lower figure. You do not get to pick, and you do not get the better of the two. Now, deeming, the bit most people find unfair the first time it is explained. Centrelink does not look at what your money actually earns. It assumes a return instead. Your bank accounts, term deposits, shares, managed funds, and your super, once you are past pension age, are all deemed to earn a set rate, whatever they are really doing. From the 1st of July, a single has the first $66,800 deemed at 1.25%. Anything above that is deemed at 3.25%. For a couple, the lower threshold is $110,600 combined. The same two rates sit either side of it, the low one below, the higher one above. The rates themselves did not change. The thresholds did. Up $2,600 for singles, $4,400 for couples, so more of your money sits at the lower rate, which lowers your deemed income, which lowers the income counted against you, which, if you happen to be income tested rather than assets tested, means a slightly bigger payment turning up. Last piece is the work bonus, and it is the most underused thing in the system. If you're working past 67, you can earn $300 a fortnight. That is simply not counted. And if you do not use it in a fortnight, it does not vanish. It banks up to a maximum of $11,800. New claimants generally start with $4,000 already there. Centrelink adds it automatically once you declare your income, but it only covers employment and active self-employment. Rent from an investment property does not qualify, and neither do dividends. So who actually gains here? If you are on the full pension, nothing changed in July. Your next move is the 20th of September, when the rate gets indexed again. If you are on a part pension, the wider thresholds mean a small lift for most people, not life-changing. But it arrives without you filling in a single form. And if you were assessed once, told you were over the line, and quietly filed the whole thing away as not for you, this update is really aimed at you. And here is what a lot of them are missing. If you qualify for even $1 of age pension, the Pensioner Concession Card comes with it automatically. $1 is the entire entry price. Cheaper scripts through the PBS. Discounts on Rego and council rates. Cheaper public transport and help with utilities depending on which state you are in. That card is worth real money. But say you are nowhere near the line. Assets well over the cutoff. No pension coming. There is a second card almost nobody talks about, and it is far easier to get. It is called the Commonwealth Seniors Health Card. Different card, different rules. And the difference that matters is this. There is no assets test on it at all. Not your home, not your super balance, not your shares or your term deposits. None of it counts. The Seniors Health Card looks at your income and nothing else. Specifically, it looks at your adjusted taxable income, which is your taxable income plus a few extras, including a deemed amount from any account-based pension you happen to hold. Under the current limits, a single can have up to $101,105 a year and still qualify. That is a long way above the pension income cutoff. For a couple, it is $161,768 combined. And those limits get indexed on the 20th of September, so watch for them moving. You cannot hold both cards, any age pension at all, and you get the pensioner card. Miss out on the pension entirely, and the Seniors Health Card is the one to look at instead. The pensioner card is the more generous of the two, but the Seniors card has no assets test, which is why so many self-funded retirees who assume they get nothing actually qualify. So here is the one thing worth doing this week. Work out your assessable assets, everything except the house you live in, and hold that total against the numbers in this video. Quick one before we finish up. Everything in this video is general information only. It is not financial, legal, or professional advice. For your own situation, it is worth getting independent advice that actually fits you. If this cleared a few things up, do me a favor, give it a like. It helps this kind of content reach more Australians who need it. Subscribe and turn on notifications so the next one finds you. See you in the next one.